Hello everyone. I'm going to be talking about cost of redeemable preference shares. So the cost is financial management. So the cost of redeemable preference shares. Redeemable preference shares represent a strategic financial instrument allowing companies to secure necessary capitals while catering to specific shareholders' rights. This presentation examines the associated costs, potential advantages, and the broader implications of redeemable preference shares for both investors aiming for stable returns and companies seeking flexibility financing options. So let's talk about the definition and the characteristics. Characteristics of redeemable preference shares. So redeemable preference shares are shares that can be repurchased at a predetermined price after a specific date, and dividend offers fixed dividends that must be paid before common shares dividends, and redemption rights that allows companies to return capitals to shareholders after a defined period. So costs of components. So understanding the various cost components associated with preference shares is essential for effective capital management. This includes the dividend cost, redemption price, and instance costs, all of which play a crucial role in determining overall capital cost. So what are dividend cost? The primary cost is the dividend payment, which is usually higher than the interest cost of debt, reflecting the higher risk taken by preference shareholders. Redemption price. The price at which the shares are redeemed can significantly affect the overall cost and must be carefully considered during issuance. Issuance costs. These includes the underwriting fees, legal expense, and other costs associated with issuing preference shares, which can add the overall cost of capital. The benefits of the company are the capital raising, easy raise capitals without diluting control since preference shareholders typically do not have voting rights, and tax benefits that are dividend payments on preference shares may be treated more favorable for purposes compared to debt interest, and financial flexibility. Redeemable preference share enables companies to manage their capital structure effectively, so the risks for the investors include the limited upright potential, redemption risk, and the credit risk. So they are return on redeemable preference shares are often capped, limiting profit potentials during strong market performance. And investor may have their share redeemed at inconvenient times or price if market conditions shift negatively. Investors face the risk that the issuing company might default on its dividend or redemption obligations. So there are valuation methods that are DCF, discounted cash flow analysis, calculating the present value of future cash flows, including dividends. Market comparables, comparing redeemable preference shares with similar instruments for valuation insights, and yield analysis, analyzing the yield versus the company's cost of equity and debt. So the redeemable costs formula with examples are given. So cost is the redeemable preference cost is the return expected by the investor, includes the fixed annual dividend and the redemption value at maturity, used for calculating weighted average cost of capital (WACC), and the formula has been given, and example of numerical has also been given. So the importance of redeemable preference shares. The redeemable preference shares serve as an important tool for companies looking to balance the capital structure. However, the company's investor must carefully evaluate the associated cost benefits and risks to make informed financing decisions. Understanding these factors is crucial for effective capital management and investment strategies. So, capital structure balance, cost benefit evaluation, and risk assessments. The importance of redeemable preference shares and the conclusions. So the capital of redeemable preference shares shows the actual return expected by investors. It includes both dividend payments and redemption values, helps in calculating the company's overall cost of capital. Guides managers in making better financing and investing decisions, ensures a balanced capital structure with minimum cost, lower cost of capital, higher probability, and shareholders value. So, and essential for strategic financial planning in every organization. So the key takeaway in this PPD is that understanding the concept and the formulas. The cost of freedom formula is essential for accurate financial assessments and application in real world scenarios and the future consideration. Thank you.